bond traders get a little break today with the Veterans Day holiday in the U.S., but without a doubt, they are keeping abreast of all the latest coming out of the G20 meeting in Seoul, headlines from Europe, and obviously commentary on QE2. Well, our next guest knows exactly what I'm talking about. She's Kathleen Gaffney. She's a portfolio manager at Loomis Sayles. She co-manages the firm's $20 billion plus flagship fund, which has a year-to-date return of just shy of 14.5%. You can see it right there on the graph. Well, Kathleen joins us now from our Boston newsroom. Kathleen, good to see you.
Hi, Lisa.
Hey, let's start on a big level here, macro perspective. What are you watching most closely right now? How are you impacted by QE2, if at all, and maybe you're impacted more by what's happening right now in Europe?
Well, right now what we're watching is the pace of the recovery. It's very gradual, which I think is frustrating for investors, but I think it's moving in the right direction, and so that's a positive. In terms of QE2, I think that the Fed's in a bit of a rock and a hard place in that in order to get traction in the economy, we need a little bit more confidence, and the confidence is coming from rising risk assets. The equity market has been very bullish about QE2.
Let's talk a second. Let's look overseas right now. I mentioned this just a moment ago, and we've been talking about it all day. Of course, the G20 meeting. Everyone talks about growth in China and India and in the Asian region overall. But from a bond investor's perspective, are those attractive markets to you? I know in terms of the countries you have exposure to, really only Indonesia, I think, is on the list of Asian countries, and I guess Australia might count in that group.
Yes, I think bond investors can take advantage of the growth that we're seeing coming out of the developing world. And it's not specifically a fixed income play, but more of a currency play. That as the global economy transitions from the developed world, handing some of the growth to the developing world, that part of the imbalances will be corrected by appreciating currencies. And where the strong growth is very much coming out of Asia. And you're right, we do have exposure to Indonesia and Korea as well. And those peripheral countries, Australia and New Zealand, are benefiting from the strong growth in the area as well.
Those are Australia and New Zealand rank as your top two countries at the moment. You also like Canada.
We do like Canada. I think Canada works very well for both the short term and the long term. The long term because of the leverage to natural resources, that commodity exposure that I think is very much a long-term secular trend. And it, as you notice in the currency markets recently, even with some of the volatility in Europe and Japan, you're seeing the commodity currencies actually hold up very well. So we see appreciation potential there, but also in the short term, Canada, Australia, New Zealand are really the good guys in the developed world. They've got sound fiscal discipline. They're actually growing at fairly healthy rates, and those markets are deep and liquid. So as choppy as the markets are, if we do get some hiccups in the market, it's a great source of liquidity as well in the short term.
Kathleen, in 2009, your bond fund had a return of 37%. It sounds like the good days in the equity markets, bond investors aren't necessarily used to those types of returns. Is that repeatable? Do you expect that for 2010, 2011, and 2012?
Certainly not on an annual basis. Certainly not on an annual basis. But I think we do see potential for continued very strong positive returns through the balance of this year and next year, because we think that interest rates will be lower for longer, and I think that's got investors looking for yield, and because of the steep yield curve, that's an incentive to take risk. The fundamentals and the technicals are both supporting positive returns in the credit markets, and then hopefully continued appreciation from our non-dollar exposure as well.
What do you think about what's happening in Ireland at the moment? Is this an opportunity for some investors who can sort of shut their eyes and take the leap to actually get involved, to actually pick up some bond exposure?
Yes, I think the debt sovereign debt crisis in Europe is presenting opportunities for investors who have a long time horizon. Clearly, the headlines are getting very negative, and there's a lot of fear in the marketplace, and some holders who simply can't take that volatility. However, at the end of the day, these are very productive countries with long-standing institutions that will have access to capital. The challenge is that they have large debt burdens that need to be dealt with. There are lots of questions about how this is going to get resolved, but I think the bottom line is that there will be resolution and there will be access to capital.
Let's talk about the U.S. at the moment. I know treasuries are not one of your top investment picks, but where else do you see opportunity within the U.S. debt market?
I think in the U.S. debt market, credit is where you want to be. There is still value in investment grade and high yield. I'd favor high yield a little bit more than investment grade, just purely by the yield advantage. I would caution, though, that this mad grab for yield is pushing valuations in the short term a little bit ahead of the market. So you have to be really careful about your credit selection, particularly in high yield. So a good value, but be selective.